In today's video, we're going to learn about breaker blocks, what a breaker block is, and how to trade using it. Before diving into breaker blocks, we need to understand their definition. What exactly is a breaker block, and how is it created in the market? We have written down the definition here, along with the key rules for breaker blocks. A breaker block is formed when an order block fails. If the market is in a selling trend and it doesn't respect the selling order block, meaning it aggressively breaks through it and moves upward, then when the market comes back to test that area, the failed order block area acts as a breaker block. However, there are three key rules for this. Rule 1. An order block must fail. When an order block fails, it converts into a breaker block. That's the first rule. Rule 2. If there's a liquidity sweep within that area, it makes the breaker block even stronger. Rule 3. There should be a market structure shift or change of character. When these three rules are met, you can confirm that the failed order block is now acting as a breaker block. The example I've given you is for a buy scenario. If you reverse it, it becomes a sell scenario. Let us show you how that works. If the market is in a selling trend, making lower lows, it comes up to test an order block but doesn't respect it and aggressively breaks through it. This creates a structure shift, and if there's a liquidity sweep, it makes the breaker block even stronger. Even if there's no liquidity sweep, the area still functions as a breaker block because two rules are fulfilled. The order block has failed, and the market structure has shifted. If the third rule, liquidity sweep, is also met, the breaker block becomes even stronger. The market then tests this area and moves upward again for a buy trade. This is how a buy example works. For a sell example, it's the opposite. In a selling trend, the breaker block is observed at the lows, while in a buy trend, it's observed at the highs. To summarize, the market breaks the break of structure here, which we have marked. This is an impulsive move when the market suddenly moves upward, creating an order block above the low. Then, the market aggressively moves down, failing the order block by not respecting it. You might notice that the upward move could be a liquidity sweep. After that, the market shifts its structure and tests the same area again. When an order block fails, it's renamed a breaker block. Now, we will show you two examples on chart. One for a buy and one for a sell. We have already explained the three main rules. The order block must fail. There should be a liquidity sweep, and there should be a market structure shift. Let me demonstrate how this works. First, let's look at a buy example. The market is in a selling trend here, and we've marked a break of structure. No order block has failed yet. Here's an order block area identified by the wicks on the black candles. We will mark it as an order block. The first rule is that the order block must fail. As we move forward, you can see the market has failed this order block, fulfilling the first rule. Now, we check the second rule, liquidity sweep. After making a low, the market has swept liquidity here, fulfilling the second rule. The third rule is a market structure shift or change of character. If you look at the internal structure, the last wave before the structure break forms the highest point here. After this, the market breaks the structure and creates an order block. When all these points align and the order block fails, that area becomes a breaker block. Now, let's talk about entries. Once these three rules are fulfilled, you can take aggressive entries with a stop loss placed below this area. You can easily achieve a 1-to-3 risk to reward ratio. If you think the market can go higher, you can use a 20-period moving average on TradingView or Exness web version. As long as the market closes above the 20-period moving average, you can stay in the trade. If it closes below, you can exit. In this case, the market gave us roughly a 1.5 risk to reward ratio, with a target of about 850 pips on this breaker block. Now, let's look at a sell example. The first rule is that the market must fail an order block. Here's the last order block point, and the market has aggressively broken it, meaning it failed. This creates a breaker block area. The second rule is a liquidity sweep, which the market has done by forming a wick above this area. The third rule is a market structure shift, which has occurred here. All three rules are fulfilled. You can take an aggressive entry here with a stop loss above this area. We mentioned two targets. Either use the moving average to maximize profits or set a fixed 1 to 3 risk to reward target. In this case, the market gave us a 1 to 3 risk to reward ratio with about 650 pips in just 2 to 3 candles. So guys, we hope you've understood breaker blocks completely. What rules to look for when identifying a breaker block, how to take entries, what a fixed target is, and how to use a moving average to set targets. Make sure you join our Telegram, where we shared our analysis, trades and updates. Link is in the description. See you in the next video. Until then, bye.